Hello and welcome to Financial Accounting with Anne Marie Anderson. Today we will spend some time working on long-term assets. Long-term assets are resources a company owns and expects to use for more than 1 year to generate future economic benefits. As always, let's get started with some common long-term asset examples. Plant assets. No, not that kind of plant. This is the kind of plant we're talking about. Plant assets are used in business and are often referred to as property, plant, and equipment, or PP&E. It typically includes buildings, land, equipment, furniture, vehicles, and computers, all long-term tangible assets. We do need to take a second on land, though, because there is a separate item called land improvements that is categorized separately. Land is simply land, as you would expect, but land improvements are items like fences, light posts, driveways, and parking lots. Even landscaping gets included in here. Why does this differentiation even matter? Well, it's because all plant assets are depreciated except for land. Land is never depreciated. Okay, so on to the journal entry. When we purchase a plant asset, we record the cost paid for the asset as a debit and a credit to mortgage payable if it's something like a building, or cash for something smaller like a computer. There's only one thing here that may not make sense. Don't we record for the purchase price? Isn't that the same as the total cost we paid for the asset? The amount we record on the books is for all the costs of acquiring that asset. It could include the purchase price, realtor commission, legal costs and fees, surveys, renovation and repairs, taxes, and even delinquent taxes in some cases.
Wow! Once you add all of those extra costs together, the amount recorded on the books can be much higher than the purchase price.
Yes, all the costs of acquiring an asset, getting it to the purchaser, and functioning properly are included in the cost of the asset. We call that total amount the book value once it's recorded. Recording an asset for what it actually costs to acquire it is a cost principle. Let's shift gears for a second and talk about intangible assets. They would include patents, which is the exclusive right to make something for 20 years, copyrights, the exclusive right to sell creative works, trademarks, which are items like McDonald's Golden Arches or the Nike swoosh, and lastly, goodwill. We are going to take a quick look at goodwill since this one is a specific accounting term. To explain goodwill, let's check on Julian, who has decided to sell his business for $75,000. But when we actually look at the assets of the business, they only amount to $40,000. Well, that excess of $35,000 that is paid is due to goodwill. It's meant to account for things like reputation, customers, etc. Things that are difficult to put a number on. Classifying long-term assets is important because it shows the resources a business plans to use as it grows and operates over many years. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.